The FBI classifies mortgage fraud under what's referred to as financial institution fraud. These include crimes targeting retail banks, credit unions, and other federally insured financial institutions. They're characterized by some type of material misstatement, misrepresentation, or omission related to a mortgage loan application. Generally speaking, they fall into two categories: fraud for profit and fraud for housing. The FBI places a higher priority on the fraud for profit. There are four primary ways mortgage fraud is committed. The first is by knowingly making, using, or allowing any deliberate misstatement, misrepresentation, or omission during the lending process. This is especially true when there's the expectation that the misinformation will be relied on by any part in the mortgage transaction. The second opportunity for fraud occurs when a person receives any proceeds or other funds in connection with a residential mortgage closing that they know resulted from a violation. This would include kickbacks or fees illegally charged to the borrower. A third method is by conspiring to perform or allowing either of the previous types of actions to occur without intervention. This means that even knowing about fraudulent activities and not acting can make you complicit. Finally, filing or causing to be filed a deed of trust that you know contains a falsehood with an official body is also a form of fraud. The two elements I want to emphasize are intent and awareness of a lie. There's no such thing as accidental fraud. While people do occasionally make mistakes, it's the intent to do harm, financial or otherwise, that makes a difference. Failure to correct a mistake after it's been discovered can make you just as responsible as if you had deliberately made the mistake. Virtually any type of fraud associated with mortgage lending will be classified as a felony and prosecuted that way. The reason for this is that the fraud of this kind rarely involves a single act or victim. It often involves violating multiple laws and cheating more than one person. As a result, there are many different penalties and punishments that can apply. Aside from criminal penalties, like imprisonment and fines, one of the harshest penalties that can be applied is loss of license. When an MLO's license is revoked, they are barred from participating in the lending industry for life. Even if there are no other sanctions, a person can lose the ability to ever work in the financial or real estate sectors again. Less extreme penalties include probation, restitution, and fines. Probation can be used to show licensees function within the law. Restitution is used to recover financial losses suffered by third parties. For instance, it can be used to repay borrowers for monies obtained illegally or funds skimmed from lenders. Fines are punitive, and almost all crimes at both the state and federal levels charge fines for violations. Monetary damages imposed can be particularly high when an offense is committed by professionals and involves numerous transactions. Even a single count can incur heavy financial costs.